Equities have recovered the ground they lost due to the Middle East conflict, but should investors be expecting a choppy ride ahead, or can markets expect to show us some more resiliency? There's a lot going on there. Brad Simpson, Chief Wealth Strategist, TD Wealth. Always great to have you in the studio, my friend.
Great to be here.
I was just sitting, from a layman's perspective, I was just watching, the action of the past month. There's this trigger event. It starts in Washington in terms of some sort of policy. And it just reminded me of last year. There was a trigger event. It happened a month later in April. Policy, the markets sold off, and the markets regain almost in short order. What's going on? How should we be reading this market?
Actually, I think that's a really great tie-in actually between the two. If you look at Liberation Day, maybe one of the most astonishing things was that the surprise of what was being implemented, and then the correction occurred. It was kind of like it was telegraphed, and then you kind of fast forward to here, and you've got two aircraft carriers sitting outside, of Iran. The poly markets had it at a 68% that by the end of March, there was going to be some sort of either escalation of some sort into Iran by the United States and Israel. I think the starting point of that was, unlike Liberation Day, I think we really looked at the market reaction to it. I would say the market has been remarkably resilient. You forget that. Let's go to the lows of this market and say, if you wanted to find the day, the perfect day of the trade, from top to bottom on the S&P 500, you can go from the highest ever to the low. It would be a 10% correction. You probably, if we're being serious, and go, it's around a 6 or 7% correction for that. And I think in a little bit of when we look at that, I think that the difference is that number one is that as we were moving through the fall of 2025, and you and I had talked about this, and we've written about that length, and we put our money where our mouth was on this, was saying, that the U.S. economy, the Canadian economy, the European economy, and then even going into emerging markets where we're starting to improve and starting to get kind of, and the more you looked at it, you started to go that, it's been particularly in the United States, you kind of got this early to mid-stage economy turn up. And the market in last fall started to broaden out and started to, move away from those kind of big tech names. We're on there talking about ultimately the software correction. And so what was happening is you had a market correction where really what was happening is money was moving out of the kind of the growth and momentum, and what it was moving in towards was the broader market and moving into and that move, I think, almost accounts for more of the correction that we saw, and it was just a readjustment. And between the market expecting it and what was going on inside of that market, I think that you can explain away a lot of that here, and then you kind of got to go, okay, now that we've done that, where do we go from here?
Let's talk about where we go from here, right? Because the news flow is so intense on a daily basis. When I can read a headline that says market regains its losses of the conflict, and for a day there's not a crazy headline that makes me worry about everything, I take a sigh of relief, and I want to pretend that everything's going to be great.
Right.
Let's talk about it. Is everything going to be great?
Right. No, I don't think everything's going to be great. But and I thought we would answer this, and that I don't have the power of foresight, but I thought I would bring this along. And what we're looking at is a scenario analysis that'll be coming out in our quarterly strategy at the end of the quarter. So, again, about a week or so here. But looking at this, the most important I want us to look at is description. So let's call that time. Okay, and key driver, let's call that inflation, sticky inflation, or stagflation. These are the major determinants. So this is looking at going, okay, what's going to happen if we have this blockade leads to a quick resolution. That's the bull case. And I'd be a little, and in bull cases, let's call it 20% scenario here. Rapid de-escalation. Oil starts panning out to $70, $80 a barrel. This is going from the beginning of this year, January 31st to December 31st, 2026. You would see the S&P 500, a bull case could be up 24% of the year, TSX up 19. Look at the base case then, is call it 90 to 110. You look at a S&P 16 up 11. What you're looking at there is you have stickier inflation. So interest rates, instead of declining, which you do in the bull case, you see them kind of staying where they're at. The bear cases is that this gets longer and prolonged, and this get $120 barrel of oil. So growth starts to, not only does growth slow, you start to look at not inflation, but you start to see stagflation. So you see slower growth and higher inflation. What you see there is you actually see interest rates move up because you're kind of in this shock, and then you start to see them go down after that, and that's where you see a correction of, called the S&P 500, 13% and 19% there. At least it starts to frame out what are the things to really look for. Duration. Right, time. How long does this play out? Because as long as it plays out, it impacts the oil price, and as long as the oil price, it impacts on. Right now, inflation isn't a problem. That $90 to $100, inflation gets a little stickier, and that's base case is where we're at right now, right? And so I am comfortable with saying that is. But if this becomes something more longer term, which it has a real potential to, I'm not sticking my head in the sand on this one, right? But at least I think I wanted for your viewers to kind of go, let's frame it out and know where, and then we know how we're going to make decisions. And I think that's a terrific start. Since
we don't know exactly where we end up in that frame, is there a sense there that sentiment is getting tested and that perhaps people are getting a little cautious in the markets?
Well, you would think, but the reality is we see something quite different than that. And I brought something. I brought it. I don't know if you guys have it, but I brought a chart along that we can actually look at there. So let's look at this. So this is tying into, if you look in the middle of the chart, it says tariff chaos. And what you see there is that's the black line is the S&P 500. The green is the greed and fear. It's our greed and fear. It's a proprietary measure that we made up of hard and soft data of looking at what sentiment is. And what you're seeing is during Liberation Day into that, you're seeing this plunging in, and as it actually is plunging, you're actually seeing that fear is increasing, and then you're starting to go up as it starts to reduce. You saw that during Liberation Day, you can even call it kind of starting April 2025 to now. And what we're looking on the far right-hand side of this chart is we're looking at same thing. You're going into private credit concerns, which was driving sentiment lower and getting more and more and more difficult. And then you get the war in Iran, and sentiment got very ugly. What you're seeing now is you saw both the S&P 500 start to spike up on the far right there, the black line, and the green line, sentiment's dramatically improved. And you know what I kind of account for that is I think a couple pieces. One that, in, let's call it the last 5 years, and you and I've spoken about this a couple times, is that retail, everyday investors have gotten way more involved in public markets in the short term. And they move very quickly on going from one place to the other place. The second part that I think we've seen that are going on in the markets is that a lot of trading in markets are done on algorithms in the short term now. And so if you go, the way algorithms often work, it goes, well, oh, there's an invasion. Oil could, to my scenario analysis, oil could go high and could go high for a really long period of time. Oh, there's peace talks. Oh, oil could be softer. Stagflation won't happen. Things will get better. And the algo changes its trading mechanism. And so the movement the movement of trading based on headlines, based on short-term activities, that you're taking out data and saying, okay, but extrapolating what's going to go forward has way more dramatic impact now than it used to. And then the last one was this, is I think if you looked at back to Liberation Day, as that rally started, I would argue a lot, as an allocator of capital, a lot of long-only equity managers stayed on the sidelines and said, hey, look at this. And this time, we're going, well, boy, I can't get left behind on here. So I think you're seeing some of that kind of rally into this market too. So you get the kind of combination of the day trading and algos and the pros.
Still
all
feeling
for
the bruises of last year, right?
Yeah, all for 3 varying degrees of difference on why. And that gives you a pretty picture of why I think you see the sentiment change that you've seen as rapidly as it's gone.